Welcome back. Michael Browne, Macro Moments, part 2. Stuart's still with us. Ollie's still with us. We've got a few questions that we think we'd like to get our teeth into for the next sort of 10, 15 minutes and give everybody, I hope, a little bit of extra, a little bonus pod. First question is about going back to the pension issue. And it's come in and it's saying, look, £1 million pension pot, that's your aim, okay? But £1 million pension pot, 4% yield return, age 60, how are you going to live on 40 grand a year?
I certainly won't with 4 kids and private school and the rest of it. No, it was just a target. It's an interim target. I need much more. That was the money I was left with post-divorce. It was just a headline number for an article, but no, it's not enough for me. So for a lot of people it will be, but not for my family.
But that asks a secondary question, which is realistically, the maths behind that is you get to 60, you take it out of all your growth equities, all the things that's produced that rate of return, and you chuck it into an annuity or you chuck it into a gilt for the next sort of 20-year gilt, giving you sort of 4.5%, 5%. Is that really the way forward for people?
Absolutely not. And I don't think good advisors are advising that anymore. And I mentioned that in my previous, I think, you can keep a much, much higher allocation to equities now deep into older age than you used to.
Yeah, I agree wholeheartedly with that. And I think that the lifestyling mechanism for most people's financial plan is not really caught up with the changing pension environment. And that this idea that you are driving your accumulation phase to a fixed point in time, 60, 65, and as you allude to, you get there because you want to direct that towards an annuity. That's no longer the forced issue. And it was never really the optimal point to buy an annuity anyway, which is probably closer to 75, 80 in the first place. So what we're really looking at, when I look at those lifestyle, particularly in my own portfolios, I don't need to bring down to that point. When I get to my retirement age, I've got another 20, 25 years of time frame to be my friend, to allow me to put a little bit more equity risk on the table. And then all I'm really trying to do is fund a 3-year rolling cash flow pot. And, that's probably where you get a little bit more sensible, where you allocate your growth pot and then you just keep moving into your topping up your cash flow pot at optimal times. So I think there's still time to make your investments work for you.
And if I look at the profile of the average person, there's 40% of their wealth is in their property, 40% is their pension fund, and the 20% are other assets. There is a lot of movement between those assets. I mean, we're only talking about 40% of your overall assets. There's a lot of other things that you could do within that portfolio in terms of managing it on a broader space. So I think we would all agree that please don't sell all your equities when you hit the age of 60. There's a lot more to do at that particular
unless you've got a huge pension pot sitting behind, you don't need to take that additional risk to fund your lifestyle. I mean, conversely, to people with smaller pension pots that probably need to take a little bit more long-term equity risk to sustain their 20, 25 years of retirement.
Yeah, absolutely. Absolutely.
That's not advice, but that's just a view that you have to look at risk in a different way when you're retired.
And statistically in the UK, the fastest growing age group for people in employment is actually the over 50s, which tells you a little bit about that question as well. US inflation.
Yeah, it's a tricky one at the moment.
What do we think?
Everyone's going a little bit mental because on the one hand, inflation expectations are creeping up. And on the other hand, there's a bit of a, which way around is it? A bit of a bear flattener going on at the moment
absolutely.
with the spread between 2 and 10-year narrowing. So what do we think? On the one hand, I think it's because the unemployment data is a little bit hard to read, isn't it?
Choppy, I think is the word.
Yeah, we all thought it was going to continually to trend worse.
Yes.
And June notwithstanding, most of the indicators, JOLTS, etc., have actually started to improve. So people are a little bit sort of confused at the moment what the picture is there at an expectation level.
From where I would sit, I would look at those productivity gains that you mentioned there. There's clearly something's going on there. The utilisation rate of labour hasn't changed a lot in the US. It looks a little slack in there, but it just doesn't move. So maybe we should just ignore that, full stop. Those productivity gains seem to be happening in what is a quieter than we thought labour market. And certainly the average earnings increase numbers wasn't particularly sort of squeezy at this point in time. We know that the US economy is really good at taking an oil price shock, running it through the system really quickly, and then running it out really quickly. So we're probably through the worst of that, if not completely through most of that. at this particular point in time. So I would suggest, and that goes back to our survey, I'd be really quite sanguine about US inflation at this particular moment in time, which means that steepening element or that bear flattening that you're seeing is clearly an expression of the expectation of 2 rate cuts before the 1st of March, which are clearly completely off the table at this moment in time, and we'll play the wait and see game. And we'd expect nothing. We'd expect no changes.
Okay.
Lots of movement, lots of talk, lots of discussion. No doubt Jackson Hole will be very exciting coming towards to the end of the year. Less instruction from Kevin Walsh, but I go back to what I said earlier, that we think he's just on the hawkish side of things rather than the dovish side of things, which may again give us a bit of help as we go through the markets over the rest of the year. AI, long-term impact on the labour markets. Here we have something where everybody tells you that you can increase your productivity by 20, 30, 40% once you get to use it properly. The flip side is that, does that mean I need 20, 30, 40% fewer people, which is deeply deflationary?
Yeah, and look, I mean, the honest answer is I don't know and nobody knows. I suspect one of the reasons the market is so strong overall, and in particular in these stocks, is that investors with a 20-year view are discounting cash flows that would have gone to workers and employees that will accrue to equity holders, suggesting fewer workers. That's probably a logical, it's certainly a logical hypothesis. On the other side, you take the NVIDIA CEO's view and say, hang on a minute, if I've got 20 software developers, if I can give them a tool that makes them 10x more efficient, do I cut them down to 2 or do I hire 100 more of them? And I think your answer to that question changes everything. If it's the first, it's deflationary and we're in for a big level of social upheaval and unemployment and all the rest of it. If it's the latter, then you're talking 10% GDP growth and productivity bubble and and valuations are cheap probably.
Ollie, what would your view be there?
Well, that's a well-articulated view. It's the unknown. So I think from my perspective as a portfolio investor, really, we're prepared to ride the wave a little bit more and keep our eye on that. But I don't know what I think Stuart's articulated that pretty well.
I'm going to put a slightly different spin on it. I mean, there is clearly inflation in the picks and shovels at the moment, in terms of chips, in terms of the demand for product, in terms of the demand for whether it's energy in localized areas where you can't get it, whether it's water, etc. There is clearly some inflation around those data centers. What is interesting is, though, if you look at the inflationary numbers and you think about the inflationary numbers, actually where AI touches it through your smartphone or your tablet is the sort of thing that doesn't make a big difference in the index. I mean, the index is about food and transport and housing costs rather than anything else. So I don't think it's an inflationary impact. So I don't think there's pressure from that side particularly. But when it comes to the labour market, what we've seen in every industrial revolution is that people don't go home and sit on their hands. There may be some frictional unemployment. I completely understand that. And that we should probably expect, where people have to move and retrain and go somewhere else. But the idea that we will all be working 20 hours a week, and by the way, it was a piece that was put out by Keynes in 1930. What should we tell our grandchildren, right? Completely wrong.
Yeah.
Because we don't sit there saying, do you know what? I want a flat standard of living and I don't care. I'm just going to stay here. We want to see improvements in our standard of living relative to the last 10 years or relative to our parents. And so that sense that we will sit there and accept a flat standard of living is something I think is intuitively and factually wrong. Yeah. And therefore, I suspect there is some idea that we haven't thought about that spins out of AI at this particular moment in time, which becomes a significant employment creator and a significant opportunity set for both ourselves and, more importantly, perhaps the generation coming next, which is our kids, who I know are worrying about exactly this particular point. But the market and the economy and our desires and economic history say, no, this is not going to wreck the labour market. It's going to lead to something else, which leads to more growth, not less as a result.
Stop watching Terminator. I think
Well, they thought the washing machine would lead to more leisure time for housewives, and that never does. These things never do.
Exactly. And clearly, some areas, and I think there's got a great example of this at the moment, the pressure on the price for something you can consume in the moment, be it a Harry Styles concert or a World Cup ticket, clearly there's pricing pressure in that area. So you can begin to see the market begin to focus on other areas and other growth businesses. And those businesses, I think, are something that we need to think about how to get somebody to consume in the moment and what price will they pay for it.
Yep.
Active investment came first. Then obviously we had the papers in the 50s and 60s showing that passive investment had a real opportunity set here, and it wasn't just about costs. There was obviously some question of skill. We look at the markets now, and we see that as the market leadership has narrowed, we see that only about 30% of all funds are outperforming the S&P large cap index at this point in time. Where should we sit on this active-passive debate? Should we be going, this is an exceptionally bad period for active, and passive has done a great job, but actually it fulfills only this much of the market? Or should we be sitting there going, you know what, the best way to take an exposure to equities, which is a long-term asset, is through the index itself, even though that index is probably the most skewed it's ever been?
Yeah. The way I answer this question is to say that it depends. So there are cycles in markets where dispersion increases and dispersion between the performance of stocks narrows. And when dispersion is extremely narrow, i.e. the difference between the best performing stock and the worst performing stock is extremely narrow, it makes more sense, all other things being equal, to go into a very low cost ETF, because the chance of an active manager to pick winners and losers is greatly reduced. In periods where dispersion widens, or in markets where dispersion between stocks is extremely wide, Latin America, for example, Asia is another, that allows active managers to produce the chance of producing more alpha. And in those periods, I would allocate more money to active managers to give stock pickers the chance to shine. As it happens, after a prolonged narrowing period, at the moment, dispersion is actually increasing in large markets such as the US. So if you are inclined and think you know a good stock picker, now is the time to give them some money.
Ollie, you use both parts of both sets of instruments.
Yeah. So I mean, I'm just going to pick up quickly on Stuart's line about stock pickers and letting them shine, because in many ways, people are looking at active management from that bottom-up level, and this is about identifying stock pickers. And certainly when we're operating with our systematic equity approach, that's an element that we do try and isolate, this kind of stock picking skill. And what we've kind of found out that stock picking can sit within an active fund and exist within an active fund, but be completely diluted by other factors within that control the return profile of that fund. And that could be just the structure of the fund, the objective, the benchmark, the risk constraints. There could be any number of factors that are skewing or diluting the skill of the underlying manager. And so when you're looking at outsiders and observe, you can sit there and go, active management doesn't work. There's general, no one beats the market. What are all the standard tropes that get rolled out without really understanding the dynamics of the individual fund at play. And so we think we can identify individual stock picking skill, which is basically what you want from that alpha generation, and then apply it to a place, isolate it from all the kind of unrewarded risk factors that are at play, style, size, and everything else. So we think from the bottom up, I still believe that there's something at play. There is skill. You can identify it. You can isolate it.
So if I neutralize all my factors, right, and that's hard to do in a portfolio when you're actively managing, but if I can neutralize all my factors, there is always going to be a residual risk left, and that residual risk left is the human piece.
That's
the stock selection.
So that's basically the fun. Yeah. If you extract everything else out, what you're left in is going to be broadly that stock picking skill. That's part of our methodology, but that's the bottom up element. I mean, I also think about it from the top down element, because we use passive strategies, we use systematic, which is active, and we use fundamental active strategies as well, and we use them for different elements of the portfolio. But our starting point for anyone is, I do believe in active management because, does it work? I think there's a pull to say, if there's an alternative for global equity markets, you buy a global equity market, hold on. If you don't think that there's any merit in weighting geographically or for obvious strengths, but if you are making active regional decisions, then you're an active manager. If you're making a decision between I want a UK home bias versus global, that's an active management decision, and you're going to be rewarded or punished for it. So active management happens at that strategic asset allocation level. It acts at the tactical asset allocation where you're shifting or rebalancing. This is all active management, and then you're getting down to the fundamental stock level.
And
So I'm all in. But I think you can be an active manager with purely passive instruments. That's kind of, and that's where I think Stuart's sitting up.
And I would just add one other thing to that, which is, the point of capital markets per se is to take assets from, a non-performing area, giving you no return, and take it to an area of some return. Now, people will have either very low, so you have a low risk tolerance, then obviously you're going to be working your way through government bonds or very short-term cash instruments. But the whole point is to recycle cash into other industries, into other places, and to create value by giving people the opportunity to create value. And clearly, that is an active process. There's no other way of doing that. That is an active process. Now, we've seen, and we've seen obviously SpaceX, et cetera, some of the valuations you may not like, but on the other hand, there have been people for the last decade investing in that sort of business to try and getting it to this particular point in time. And there is an opportunity set. We shouldn't just close our minds and say active management can only be picking through an index. I think we have to think much wider than that, and that's getting back to the old-fashioned idea of what are we doing, what is the right thing to be doing in an economy as a whole, and that is to back startups and to have fresh capital and take risks to be able to obviously take supernormal returns. They won't all work. But if more work than don't, you will have a great portfolio, and that is active management.
And that's the challenge, isn't it? I mean, passive gives you broad, cost-efficient breadth to a market, and sometimes you want a bit of depth, and that's you have to make an active decision to do that. You can do it passively, or you can outsource that decision to active manager. Yeah, I think it's in play. I don't think there's an argument.
I think to make a great meal, you need several ingredients. Yeah. And that's probably the best way of putting it. Thank you very much, Stuart. Ollie,
Pleasure
thank you again.
Cheers.
I think it is absolutely time for lunch.
Yeah.